That's coming up 4 p.m. Eastern Time. Ahead of that, we have Thomas Hayes back with us, the chairman and managing member of Great Hill Capital. Always good to have Thomas. He's a very smart young man. What do you make of what the banks, first off, told us, Thomas? I mean, steady as she goes, some bumps along the way, but not nearly as many as some feared. And they are sort of like telegraphing something. What?
Yeah, there's no question about it, Neil. The key here for all of earnings season, including the banks, is expectations, because profits were down year on year in aggregate, but expectations were lower.
Very
and
good
I think
point.
That's also going to be the theme with the general market. Expectations were 7.8% earnings growth at the end of June. They're now 4.2% earnings growth. So I think that's a low bar that we can beat, and the market likes beating expectations. As it relates to the banks, the fears were around net interest income, which Brian Moynihan, who you're going to have on the show at 4 o'clock, said troughed last quarter. So that's positive news, and it was more than offset by deal making, predominantly equity and debt issuance, as well as trading as well. So
yeah, I was noticing in case of Goldman Sachs on fire with all of that deal making and all the hyperkinetic activity on Wall Street. Do you ever wonder that there's almost too much gas there?
You know, we have this beautiful combination right now of massive liquidity. We had more central banks cut last month than have cut since 2020, and prior to that, 2009, and that's historically a good thing for equity. So you have liquidity plus complacency, and this could be the first October for an election year where we've seen very, very limited volatility. So I'll be interested to see what happens in the next 2 weeks before the election. Do we get any of that normal chop pre-election like we usually see in presidential election years, or do we just power through? And right now the market's voting with liquidity and beating expectations so far.
Donald Trump has said if he doesn't win, we're going to have a market crash.
Yeah.
What do you think of that?
I think that all presidents take too much credit for the economy, whether good or bad, or are assigned too much credit when it's bad. I think the key thing that the market wants historically is checks and balances. So
yeah, we do better under split government.
Under a split government. So long as one party doesn't get the presidency, the Senate, and the House, I think the market's going to like it. I think, you know, you got GDP now up 3.2% from 2.5%. You have rail freight car loadings, which bode well. They're up. That bodes well for a manufacturing recovery. We've been in a manufacturing depression or strong recession for the last 2 years, despite the rest of the economy picking up the slack.
You know, you talk about the rest of the economy. I look at the rest of the market. It used to be concentrated in technology. Technology is still doing fine, but it has widened out considerably, and hence this argument that as we enter a third year of a bull market, we could easily match the average length of a bull market, what, 5.5 years. Some have gone on for a decade or more. How do you see it?
I love it. I love the broadening that's happened. That's a sign of health in the market. And thematically, what you see at the beginning of an easing cycle, you know, we just got 50 basis points, we're 25, 26 days in, is broadening. So the unmagnificent 493 are now going to start to outperform the magnificent 7.
But, you know, by the way, did you notice with the magnificent 7, I was shocked when I read their multiples, trading at 28 times earnings. And a lot of that has to do with the fact, the stock prices have soared, but earnings have soared. So it makes the math more compelling and not nearly as nosebleedy as we had through the internet boom.
Yeah, and I think why you're seeing the 493, though, pick up is because the earnings growth of the Magnificent 7 is decelerating. It started the year at 50%, it's down to mid-teens, and the unmagnificent 493 were negative earnings growth until the most recent quarter inflected positive, and they're going to move up to mid-teens. So that there's huge opportunities under the surface. So
let me pursue that. I think you were touching on when you were talking about maybe 4.5% earnings growth. That's off the original estimates of close to double that, right?
Exactly.
For the S&P 500.
Yep.
UBS has said something similar, out with a statement that they think earnings will contract a little bit, not go reverse, but we will see a sort of a tightening of that. Now, what would that mean if they're right, if you're right, for the stocks?
Yeah, I think as long as they beat the low bar of expectations, that's going to be the key. And looking out to 2025, you're looking at 15% earnings growth, and margins are actually accelerating. earnings. So we're kind
So
of...
this will be just a quarter phenomenon type thing. It
I think
picks
so.
up as the time goes
And
on.
that's the thematic from all the data that we look at. It looks like a short-term pause and then a reacceleration. And that's a function of liquidity and things starting to move again.
All right, got it, my friend. I always think that these guys play with us here, don't you? Where they say, you know, we're going to have horrible numbers.
Right.
And if you just mildly beat it, I pulled that stunt with my parents on their report card. It's going to be all Fs.
You know,
and they see a couple of D's and C's and they think I'm menacing it.
Neil, the secret to happiness in life is low expectations, and that's exactly what the earnings game is all about.
I built a career on it, my friend. Always good seeing you, and I really appreciate it, Tom. Tom, excellent, uncanny read of these markets. Another uncanny read of politics is